Hey man, what's going on?
Just the other day.
We had a couple of topics that might be interesting to talk about today. I got really curious about one though, which is related to bank account linking. There's multiple different account aggregators out there. So let's start there. How would you even frame this up? Because I didn't want to say, let's talk about account aggregation, because that might not mean anything to.
Sure. I think that account aggregators, they've been around for quite some time, a whole bunch of different varieties. And I think they really found their spotlight and became super popular back, I don't know, decade plus ago with the introduction of Mint. Mint, I think, was the first kind of broad-based commercial use case that enabled us to do something that we always wanted to digitally, but previously couldn't. And that was automate your budgeting, right? Being able to link a bank account, pull in all your financial data, and get utility from that data was something that we'd never really experienced before. And I remember when Mint first came out, it launched in the US. I think it proved that first use case in terms of like, this data is super useful and important. And as a fintech head, I think that the whole community started to get super, super excited around all of the different use cases that this financial data unlocked could provide us in building our businesses. And so, the use cases have evolved and shifted as we've started to get a little bit more, and experienced with using it. There's a FinTrack play in Canada in terms of identity verification that bank accounts can be useful for. There's verification of bank accounts that is super useful in terms of moving funds around. And then there's also really just utilizing the data within a customer's bank account for alternative types of risk decisions. And so a whole other data set that allows businesses to predict creditworthiness of customers, but then also to predict different types of business behavior, like retail insights and how customers spend and what they're spending on, and how to better target them with specific products and services. So, the bank account aggregation topic is one that I think actually reaches a pretty broad set of services and businesses. The question is at what will it become reliable and performant enough to use across all of those different use cases to kind of unlock this beautiful picture that we might have kind of like had in our mind the first time that we successfully linked our bank account to Mint and saw that data download magically. When does that work well enough that you can reliably use it over and over again for all these different use cases?
Got it. It's interesting. You almost bookended it where the initial use case was budgeting application like Mint, and the other bookend you kind of laid out, which I also don't think we want to talk about, is effectively open data, open access equals open banking. That is well worn territory for others, and I think just given what you and I do day to day, I mean, maybe I'll just speak for myself. Like, I don't think a lot about open banking. I think a lot about the constraints that are in front of us right now. And I think that's kind of the spirit of the conversation that you and I wanted to have. So let's talk about those use cases. I know, one of the things that seems like you just can go super deep on, and when I think that you've hit bottom, you just keep going, is the utility of this data in the context of adjudicating customers and approving them for credit. That's probably the area that I'm most curious about, because I think you're just so much deeper on that use case than I am.
Sure. I think the lending aspect is one of the most interesting, and it kind of takes you back to the origin story of how kind of alternative data can be used for credit adjudication. And what I mean by that is actually a segment of the lending marketplace that typically doesn't get a lot of credit, typically is, in the news for all the wrong reasons, but that's actually the payday loan space. And so, early in my career, I got the opportunity to work with Mogo, where we had a focus and mission to disrupt that space by coming out with new and innovative ways to offer lower pricing and more convenient and affordable products to consumers who were in the payday loan cycle. And when you started really looking deep into that world, what you actually found was a whole bunch of innovation, uh, that was moving faster than all the traditional financial institutions actually were. And I mean, there's a number of different areas that I can kind of, highlight that. But, stripping away a lot of the negatives, you look at a business who ultimately is trying to serve a segment of consumers that banks wouldn't. And so the banks and other bigger lenders had this very tight criteria and very specific pieces of information that they were looking at in order to actually issue a loan. Payday lenders, on the other hand, they were doing everything they could to be scrappy and find other pieces of data and information that they could rely on to effectively do the same thing. And so this started in a bricks and mortar environment where there was a face-to-face interaction. Identity verification could be effectively done in real time. But there was actually, in a lot of cases, two pieces of information that had to be proven. That you were employed and how much you were getting paid, and I guess how regular your pay periods were. And it was, that information that would kind of like get plugged into a calculator to help determine how much money you would be approved for. One of the things that happened with the advent of online banking is that like actual physical PCs were put in a lot of these cash advance and payday loan stores for customers to literally log in to their online banking, print out their transaction history, and then actually provide that to the CSR, who would be looking for a collection of data to actually plug into their calculators to be able to make a risk decision that any other financial institution ultimately wouldn't. And so, that was kind of bank account data aggregation before it was made digital. But yeah, it was really one of the early use cases for that kind of like transaction level data. So, fast forward, I think, into the mid 2010s, and, there's this huge rush towards lending going digital. There was, the cycles where the, lending clubs went public and like all of the lead up to, online marketplace lending. And what really happened as part of that is that these early innovators and users of this type of data really pushed a whole bunch of technical players to get into the space and start offering basically data aggregation as a service. And so it was really digitizing what had been done previously in physical locations for years. And it was a big effort though, because every bank account was ultimately, or every bank was structured differently. There was no direct integrations, of course, and in some cases there still aren't for some types of banks and institutions. And so this methodology of screen scraping and giving a business access to your financial data to help make credit lending decisions better just really evolved. From there, I think what ultimately ended up happening is more complex algorithms and uses of that data became obvious. I know we started to build scripts where we would check what other loans are outstanding, what order those loans, the payments were coming out, utilizing all that data to kind of dictate a propensity to pay based credit model. And, I think that's really where we get to today on the risk side, is like just a lot more data to use to make a lot more sound financial decisions for your customers.
It's interesting too. You talked about trying to build a model to infer when a customer's loans are coming out of their account and therefore what their cash flow is going to be. It's amazing to me how much Plaid has done over the last couple of years. Plaid, sitting on top of this network of bank accounts attached to a network of customers, is now really starting to flex by providing like fully packaged services for assessing customer risk in the US. I don't think Plaid does any of that packaging in Canada. If you're going to process an EFT from a big six bank account into a fintech account, you're not going to get anything from Plaid that to suggest what the risk of non-settlement of that payment is. I'm sure it's coming. It exists in the US. I don't know if you mentioned Yodlee by name, but Yodlee was really the first to do this, and that was owned by Intuit, and that's why Mint was using it. In Canada, we have Plaid and we have Flinks. I've personally noticed as a Wealthsimple user that when I connect my RBC account, it goes through Flinks. Can you just talk about the state of play in Canada? Like, do I need both of these? Can I get away with just using one?
Yeah. So when I started first using aggregators, the whole ecosystem was really built like from businesses like ours, convincing these US players to actually start supporting Canadian banks. And it was actually a pretty compelling early story because effectively it was, hey, support five Canadian banks and support 80% of our customers, which seemed like a really low lift for some of the early aggregators who were used to in the US basically supporting, dozens and then hundreds and then thousands of institutions in order to kind of get to full coverage. And so essentially we were able to convince them to start with like one bank and actually keep adding them individually. And then, kind of what happened, and it definitely will lead to an answer to your question, is that we really started to recognize that some of these early aggregators were really good at supporting some banks and not good at supporting others. And at the time, we were pretty uncertain as to like why that was. But a new aggregator would pop up and claim that, their success rate with like bank X was Y, and we should give them a try for that bank. All the while, the user experiences for these early aggregators was really spread around. It wasn't all API based. There was like separate web portals and, places to kind of direct your customers to, which were good for testing platforms out, but weren't great from a user experience perspective. Now what you see is mostly an API based driven model from Plaid and from Flanks, although they do offer kind of a portal based solution as well. But nonetheless, we ended up with four active aggregators functioning across several different products for specific reasons and really optimizing which service was being used for what product based on two things: how well that aggregator was at actually serving that specific bank, and then how solid their user experience was for the individual use case. And I guess pricing was definitely somewhere in there as well. But what I find today is that I think a lot of that still exists. I definitely work with a bunch of fintechs that have multiple aggregators. I think that over the next couple of years, most likely that kind of strategy will dissipate as maybe a more even playing field comes to the market with the aforementioned open banking. I don't necessarily think that's the future, but listen, for the next couple of years, I still think that it's really important to, especially if your product's like fully relies on banking data, you do have to have more than one partner.
I'm interested in talking a little bit more about where it matters to have this transaction data ongoing, and I'm kind of pointing us back towards the lending and credit use case, right? All revolving credit is effectively underwriting cash flow, which for an individual, do you get paid by an employer? When do you get paid? How much do you get paid? How certain can we be about that, given the transaction history that we see? Can you just talk a little bit more what companies are maybe doing with the data that they're staying connected to and why that matters in terms of being able to create an experience or product that maybe an incumbent isn't willing to create?
Yeah. Yeah. So, I mean, I think that there's a lot of nuance in that question that crosses over from the product discipline at some point into the credit risk discipline. So, I want to kind of be careful that I don't misrepresent my background and my skill set. Oftentimes, when building lending products, comes from a credit risk professional requirement to get me the data so that I can test and iterate on some of those models and build on scorecards and ultimately deliver the right initial product and adjust it ongoing. I think an underlooked one that maybe slightly less confidence in leveraging on a like working 100% of the time, but definitely very valuable when it can is the account balance check. So earlier, maybe I'll correct you, but maybe you meant something different. With the services today, you can definitely get a real-time balance passed back from the aggregators for a specific bank account. And so I've used that in a couple of different scenarios. One is actually in the collections use case where you've got a customer who's missed a payment and you'd like to attempt another payment from. But the last thing that you really want to do is trigger an NSF fee, especially if there's already one that's been triggered by their bank for missing an initial payment. So if it's within your rights to be able to take another payment, attempt another payment, then you can trigger a balance check first if you've got that customer's bank account linked and established. just to check if the account balance is sufficient to cover the payment before you actually trigger the EFT to take that payment. So that's a really useful function. I would also, there's some kind of tertiary use cases that aren't lending related that I've seen used for a bank account balance. A lot of programs out there that require kind of use of EFTs to pull funds from bank accounts, whether it's to pull it from an existing bank account into an investment account. I think kind of similar to what you're suggesting. You might trigger that transfer and you might say that you want to move $100,000 into your account. But at that point, the fintech customer whose app you're using, they don't actually know if you have $100,000. And so it'd be pretty risky to make those funds available away. But if they're able to leverage that linked bank account check to do a real-time balance check, they can see that you actually have $100,000 at the time the EFT is triggered, and they might be comfortable issuing you $5,000, immediately to use as you wish.
At the time the EFT is triggered is, I think, the key clause there, which for folks that don't understand that payment that gets triggered by the user inside of a Wealthsimple or a ShakePay or a Coho or a Neo, that's being transmitted to the bank who is going to transfer the funds to that fintech, later that day in some batch payment window. The user has like 6 or 7 hours to probably move that money out, and then it won't be there. So
yeah, they do. And I mean, really, that's like when the money might leave your bank account as the consumer, but the reality is that the money might actually not arrive for 4 or 5 days. So that's where that underwriting kind of, happens. And I guess that's where that real-time balance check really helps the businesses kind of adjudicate that risk and whether or not they want to issue you any money. And then, yeah, I mean, on the lending side, so, I started with that payday example, but what I wanted to actually highlight is that it started there, and then use of data for lending has really gone up market, up the credit spectrum, and is now, kind of a basic piece of underwriting criteria that's used across like so many different lending decisions, all the way up to the prime space now, right? So we're definitely talking about something that's ubiquitous and no longer, only used by alternative lenders who are trying to seek an advantage. And so the bottom line is that, I think there's a lot of different data sources that can be used for underwriting criteria. Some of them are data that is easily accessible on a customer's credit bureau. So, any reporting loans and obligations and debt that somebody might have. But I think that these days there's a growing set of like cash flow and spending behavior that can't necessarily be seen on a credit bureau. And there's also a lot of different types of employment now. And there's side hustles and there's income that's coming in that, might not be represented on a customer's bureau. If you want to be competitive with your lending strategies and look further than just like the basic set of information that everybody's looking at, then I think that it's on you to, use like machine learning models and AI to essentially attack a customer's basically transaction history, not just across their, debit accounts, but across their linked credit cards and, even some of their investment accounts, to figure out, how liquid this customer is and, what's that sweet spot in terms of getting them the credit they need in a responsible way that is beneficial for the user and beneficial for your business.
once you have this customer and you're lending to them, certainly, you would hope that they're going to procure an ever larger share of their financial services inside of your ecosystem. Payday lenders probably didn't think about that too much before things went digital. But I think right now, like we're still, certainly within the fintechs that I've worked with, I think there's still a lot more room to use this data to create better customer experiences, to lend more confidently to a broader set of customers, and so on. Would you agree with that? Have we hit the upper limit? Should we just be waiting around and do nothing until open banking is here?
No. I mean, you need to start now with the tools that are available. And what I would recommend, having done this the right way and the wrong way multiple times, if you're building bank data into your platform for the first time, is to not build it at the product level, especially if you have a potential multi-product growth strategy. Build that at the member level, at the account level. Build it as a service that can be leveraged really easily by multiple products as your business grows and scales.
I love that. Build it at the member level. I think that's it for today. All right, my man. See you next
Awesome.
week.
Okay. See ya.
Cheers.